Here's a brutal truth that will either save your financial future or explain exactly why you are still struggling to break even after years of trying. The $2,000 trade you missed this month wasn't because you picked the wrong stock. It wasn't because you misread market structure or failed to understand support and resistance. That money vanished for one reason and one reason only. You couldn't sit still long enough to let a perfectly good idea pay you. Trading isn't a game of analysis. That's the amateur's definition. The professional knows the brutal reality. Trading is a game of pain tolerance. Specifically, the pain of doing absolutely nothing when every fiber of your being is screaming at you to do something. Picture this scenario in vivid detail. You're scanning the markets during your evening routine. You've done the work. You've filtered through the noise, analyzed the higher time frames, and finally, you see it. A perfect 4-hour breakout setup. Clean consolidation just under resistance. Volume is building steadily, but not spiking yet. The tape feels controlled, professional. It's the kind of structure you tell yourself you'll wait for, but almost never actually encounter when you need it most. You mark it up with precision. Entry at $52. Stop at $50, just below the structural low. Target at $58. You run the mathematics. You're risking $500 to make $2,000. A clean 4.1 reward to risk ratio. Your position sizing is conservative. You're not over-leveraged. You're not chasing momentum. Everything about this trade screams textbook execution. You click buy at $52. For about 20 minutes, you feel like a professional. You screenshot your chart for your journal. You imagine closing this position in 3 days, feeling calm, disciplined, collected. You think you've finally turned the corner from amateur to consistent trader. Then the amateur's curse kicks in, with devastating precision. You tell yourself a lie that sounds perfectly reasonable. Let me just check the 15-minute chart. Just to monitor how the risk is developing. When you switch time frames, price is sitting at $52.20. A small green candle pulls back into a red one. Nothing unusual. Still above your entry structure. Still above support. Still completely within your plan. But something shifts in your nervous system. You zoom in again, this time to the 5-minute chart. You see more red. What should register as normal noise now feels like an emergency signal. You flip to the 1-minute chart, and your brain stops caring about structure, levels, or your carefully planned 4-hour thesis. All you can process is a stream of tiny red bars and your unrealized loss ticking higher. A 50-cent pullback that means absolutely nothing on the 4-hour time frame now feels like a personal attack on your judgment. Your heart rate jumps. You're no longer thinking in terms of risk management, position size, or pivotal points. You're thinking in terms of pain. How much more psychological discomfort can you tolerate? How stupid will you feel if this keeps dropping? Your amygdala is firing danger signals constantly. Uncertainty registers as threat. Your brain doesn't distinguish between a losing trade and a physical predator. Both trigger the same fight or flight response. You start telling yourself a story that sounds incredibly responsible. If I close now, I can always get back in at a better level. I'm being smart about risk management. I'm preserving capital. You hit sell at $51.80, locking in a small, controlled loss. You feel immediate relief. The anxiety vanishes because the risk is gone. You pat yourself on the back for being disciplined. 3 days later, that same stock is trading at $58, exactly where you plan to exit. Your smart risk management decision cost you $2,000. Not because your analysis was wrong, not because your stop loss was poorly placed. You paid $2,000 for one thing: the inability to endure normal market fluctuation without interfering. Now consider the professional trader who took the identical setup. Same chart. Same entry at $52. Same stop at $50. Same target at $58. But his process after entry is radically different. He enters the position, then does something that separates him from 95% of all traders. He sets price alerts at his stop and target levels, closes his trading platform, and walks away. He doesn't watch the 15-minute chart. He doesn't even glance at the 1-minute noise. He goes to the gym. He works on other projects. He reads. He lives his life. When his phone finally buzzes 72 hours later, it isn't because he was refreshing charts every 5 minutes. It's his $58 target alert. Trade closed. Profit banked. One idea executed according to plan. No drama. No story. Just systematic business. Here's an even more brutal example. Another trader enters a 4-hour swing position on Friday afternoon. His target is 3 candles away, roughly 12 hours of market time. But those 12 hours span a weekend. He's going to spend Saturday and Sunday imagining every possible disaster scenario. What if news breaks over the weekend? What if the market gaps against him Monday morning? What if he's completely wrong about the trend direction? By Sunday night, he's convinced himself that holding through the weekend is reckless gambling. Monday at the open, he exits for a tiny profit just to eliminate the uncertainty. Tuesday afternoon, his original target gets hit perfectly. He just donated his statistical edge to someone with stronger psychological hands. This is where Jesse Livermore's famous quote gets misunderstood by almost everyone. He said, "It was never my thinking that made the big money for me. It was always my sitting." Most traders love this quote because it sounds wise and effortless. They imagine themselves sitting like Zen monks, effortlessly holding positions for massive gains. But that's not what Livermore meant. The sitting wasn't passive. The sitting was the hardest work he ever did in his entire trading career. Livermore had already completed the analysis. He'd identified his levels, recognized the pivotal points, calculated his risk. The real psychological warfare began after he was positioned. It was the active effort of not touching the trade, of not reacting to every wiggle on the tape, of not moving stops closer when fear whispered in his ear, of letting the market prove him right or wrong without stepping in to help the process. The amateur thinks trading is about constant action. Scan, enter, exit, repeat. They define themselves by the number of trades they execute, the hours spent glued to screens, the perpetual chase for the next opportunity. They mistake being busy for being profitable. The professional thinks completely differently. Trading is a game of controlled risk and disciplined inaction. He defines success not by how many buttons he presses, but by how long he can stay out of his own way after pressing them. On the 4-hour time frame, this difference becomes amplified to an almost unbearable degree. A single 4H candle doesn't print in 60 seconds like a scalping setup. It takes 240 minutes to complete. That's 4 full hours of your brain chewing on uncertainty. 4 hours of fear whispering, "Take profits now before they disappear." 4 hours of greed suggesting, "Move the stop closer, increase size, double down." 4 hours of pure temptation to interfere with a process that doesn't need your help. If you're awake for 16 hours per day, a single 4-hour candle consumes 25% of your entire waking life. Think about that mathematics. That's a massive psychological void that your dopamine-addicted brain wants to fill with activity, checking, refreshing, and second-guessing. We live in an addiction economy, designed to exploit your need for constant stimulation. The market knows this. Lower timeframe noise exists specifically to shake out impatient money. When you zoom into the 1-minute chart on a 4-hour trade, you're voluntarily walking into a psychological trap, designed to separate you from your edge. This is the part that almost nobody prepares you for in trading education. You're taught technical analysis, pattern recognition, risk management calculations, but nobody teaches you how to sit with uncertainty for 3 days straight. Nobody trains you to tolerate the psychological discomfort of not knowing how your trade will resolve. You're given sophisticated tools for entry, but zero tools for endurance. Here's the hidden truth we're going to unpack. The hardest part of the 4H chart isn't finding the trade. It's sitting on your hands while the market does the work you hired it to do. Most amateurs are fully equipped to enter. They understand signals, indicators, support, and resistance. Almost none are trained to wait. They treat waiting as dead space, as nothingness to be filled with more analysis, more news, more charts, more opinions. Professionals treat waiting as their actual position. When they're in a trade with defined risk and a clear plan, waiting isn't nothing. Waiting is precisely their job. That's where their statistical edge lives, in the hours where amateurs panic, adjust, override, and exit too early. By the end of this, you'll understand why doing nothing is the highest paid skill in trading, and the exact protocol to stop your emotions from destroying perfectly good setups. You'll learn to weaponize boredom, Interpret discomfort as confirmation that you're in the profit zone where amateurs quit, and build a system that removes the temptation to interfere with your positions. Because the market doesn't care about your analysis. It only cares whether you can stay in the trade long enough to collect what it owes you. The $2,000 lazy trade is waiting for you. But first, you have to learn how to wait for it. On a 1-minute chart, you can be wrong 50 times in a single session and rationalize it away as scalping practice or getting a feel for the tape. The velocity creates a psychological safety net. Losses happen so fast they feel almost abstract. Your dopamine gets fed by constant stimulation. You feel productive, busy, like you're working hard at your craft. On the 4-hour chart, that illusion disappears completely. You might only get 3 quality setups in an entire month that truly deserve your capital. No forcing, no stretching your rules, just 3 trades that genuinely fit your plan. That slower pace does something psychologically dangerous if you're still thinking like an amateur. It gives your emotions room to breathe, expand, and completely dominate your decision-making process. Think carefully about what actually happens during the formation of a single 4-hour candle. That's 240 minutes of open market time. 14,400 seconds, where price is ticking, moving, fluctuating. And during those 240 minutes, your brain is not sitting quietly in meditation. It's running a continuous loop of doubt, fear, greed, and compulsive second-guessing. Here's what fills those 4 hours when you have a position running. You're checking your unrealized profit and loss every 15 minutes, watching numbers flicker between green and red like a slot machine. You're mentally spending the profit when the position moves in your favor and emotionally panicking when it pulls back. You're comparing your current position to yesterday's performance, asking yourself why this trade isn't moving faster, calculating how much you need to make back to reach your weekly goal. You're scrolling through trading Twitter, Discord, Reddit, anywhere you can find someone else's opinion to either confirm your bias or soothe your fear. You won't call it fear, you'll call it seeking confirmation or staying informed. But you're giving equal weight to a random comment from a stranger with no track record and your own carefully written trading plan. You're staring at your stop-loss level, questioning whether it's too tight, too loose, placed at the wrong structural point. You're replaying your entry in your mind, wondering if you should have waited for a better price, a cleaner signal, more confirmation. You're zooming into lower time frames, watching every tick like it contains some secret message about your trade's future. Notice something crucial here. None of this is about the market. The market is just doing what it always does, moving from one auction level to another, seeking liquidity, digesting positions. You're not losing to the price action on the 4-hour chart. You're losing to time itself. Time is the real opponent on this time frame. Time exposes every crack in your psychological armor. Here's the fundamental psychological trap that destroys more 4-hour traders than bad analysis ever will. Amateurs confuse activity with progress. We're conditioned by society, our jobs, our education system to believe that effort equals output. If you want to build a house, you hammer nails. If you want to get fit, you lift weights. In almost every area of life, doing more leads to getting more. Trading is the only profession where doing less often makes you more money. But your brain rejects this reality completely. It screams that if you're not clicking buttons, drawing lines, or adjusting orders, you're not working. You feel lazy, unproductive, guilty. So when price consolidates sideways for 6 hours while remaining perfectly within your plan, the amateur doesn't interpret this as the market digesting and preparing for the next move. He interprets it as boredom. And boredom, to the untrained mind, feels like a problem that needs solving. This is when the sabotage begins. They start looking for opportunities to optimize their position. They move their stop-loss closer to current price, telling themselves they're locking in gains and being smart about risk. They take partial profits way too early, because seeing green numbers disappear back into red feels unbearable. They add to positions at random levels because they're bored and want to feel productive. They exit entirely just to relieve the psychological pressure of not knowing what happens next. Every single one of these actions is done with good intentions. They're trying to be responsible traders. They're trying to protect capital. They're trying to maximize efficiency. But the outcome is always the same. They sabotage a perfectly good setup by interfering with a process that didn't need their help. The professional understands something completely different about boredom. Boredom is not a signal to act. Boredom is a test. It's the market asking you a direct question. Are you disciplined enough to let me work? Or will you interfere with my process because sitting still makes you uncomfortable? The market is a mechanism for transferring wealth from the impatient to the patient. That transfer happens during these long, boring periods of consolidation on the 4-hour chart. The market doesn't shake out weak hands by crashing price dramatically. It bores them to death. It waits for you to get fidgety. It waits for you to doubt. It waits for you to click close, just to relieve the tension of doing nothing. Let me tell you about a student I worked with who embodied this problem perfectly. He had been trading for 4 years. He understood market structure better than most professionals. He could identify high-probability 4-hour setups with remarkable accuracy. His technical analysis was flawless. But he had a fatal flaw. He couldn't hold a swing trade for more than 8 hours without panicking. Every time price pulled back even 2% from his entry, he'd close the position. It didn't matter that his stop-loss was still 5% away. It didn't matter that pullbacks are completely normal in healthy trends. The moment he saw red in his profit and loss column, his nervous system would flood with stress hormones. His hands would start shaking, his breathing would get shallow, and he'd hit the sell button just to make the psychological discomfort stop. Here's what made his situation particularly brutal. His win rate was 85%. He was right about direction almost every single time. The market usually went exactly where he expected. But his average winner was smaller than his average loser. He'd capture 1% or 2% on winning trades, but when he finally did hold through to a stop loss, he'd lose 4% or 5%. The mathematics didn't work. He was bleeding money while being correct about market direction. The problem wasn't his analysis. The problem wasn't his trade selection. The problem wasn't even his risk management rules on paper. The problem was his complete inability to endure the discomfort of uncertainty for more than a few hours at a time. We tried everything traditional first: mindfulness techniques, trading psychology books, journal reviews, pattern identification. Nothing worked. He'd agree with everything intellectually, then repeat the exact same behavior the moment real money was on the line. Finally, we stopped trying to fix his psychology and started fixing his environment instead. We implemented what I call environmental risk management. We didn't try to make him more disciplined. We made it physically impossible for him to act on his lack of discipline. First, we removed his trading application from his phone entirely, deleted it completely. No mobile access, no ability to check positions while standing in line at the grocery store or sitting in traffic. If he wanted to see his trades, he had to be at his desk with his computer open, on purpose. Second, we disabled all real-time notifications except for 2 specific alerts, one at his stop-loss level, one at his target level. No price alerts in between, no news notifications, no brokerage app badges showing unrealized profit and loss. The only time his phone would buzz is when a trade was completely finished, one way or the other. Third, we scheduled exactly 2 times per day when he was allowed to check his open positions, 9 a.m. and 6 p.m. Outside those 2 windows, the market didn't exist for him. He could plan new trades, he could review closed trades, he could study charts, but he could not look at anything currently open. The first week was pure psychological withdrawal. He broke the rules 12 times. He'd reinstall the app on his phone, check his positions, feel guilty, delete it again. He'd log in at random times just to make sure everything was okay. He'd convince himself that this particular trade was different and needed special monitoring. The second week, he broke the rules 5 times. Progress, but still failing the test. His addiction to market stimulation was stronger than his conscious willpower. By the 3rd week, something fundamental shifted. He stopped fighting the system. He accepted that the rules existed to protect him from himself. And during that 3rd week, he entered a long position on a Tuesday morning based on a clean 4-hour breakout. He set his alerts. He closed his screens. He didn't check at lunch. He didn't check before bed. He only looked during his scheduled windows. On Friday afternoon, his target alert triggered. He had caught his first clean 5-to-1 winner, a trade that paid for his previous 5 losses, combined, and put him in profit for the month. He didn't see the pullbacks that would have normally triggered his panic response. He didn't see the consolidation that would have bored him into early exit. He didn't see any of the noise that his emotions would have interpreted as danger signals. He was present only at the two moments that actually mattered: entry and exit. Everything in between was handled by his system, not his psychology. That single trade taught him more about professional execution than 4 years of chart study. He realized that his edge wasn't in finding better setups. His edge was in staying out of his own way after finding them. Here's the brutal lesson that's hard to accept. The 4-hour time frame doesn't reward the smartest analyst or the person with the most sophisticated indicators. The 4H time frame rewards those who can afford to wait. It punishes those who must act. It's a filter that separates gamblers from business operators. If you need to feel productive every hour, the 4-hour chart will bankrupt you. If you need constant feedback and stimulation, you'll sabotage every good idea before it has time to develop. If you measure your worth as a trader by how busy you appear, you'll optimize yourself right out of profitability. But if you can train yourself to do nothing, to sit with uncertainty, to let the market prove you right or wrong without interference, you'll access an edge that most traders never discover. You'll be present only when your system demands it. You'll be absent during all the moments when your presence would be destructive. The amateur checks his positions 40 times per day and wonders why he keeps losing money. The professional checks twice and wonders why everyone else makes it so complicated. In the next chapter, we'll turn this insight into something even more powerful. We'll show you how to transform that agonizing discomfort of waiting, that urge to check and meddle and optimize, into concrete proof that you're finally trading like a professional. You'll learn to weaponize boredom and interpret your own psychological pain as confirmation that you're in the exact zone where amateurs quit and professionals profit. Here's a paradox that will either unlock your trading career or confirm why you're still trapped in break-even purgatory after years of effort. The psychological discomfort you feel when not watching your trade, that gnawing anxiety that makes you reach for your phone every 20 minutes, is not a warning signal telling you something is wrong. It's concrete proof that you're finally positioned in the profit zone where amateurs quit and professionals collect their paychecks. Most traders have this relationship completely backwards. They've been conditioned by every other area of life to believe that comfort equals correctness. If a trade feels easy and stress-free, they assume it's working according to plan. If holding a position creates anxiety, generates doubt, or feels psychologically difficult, they interpret those sensations as red flags that demand immediate action. So they exit to eliminate the discomfort, then watch in agony as the market continues exactly where their original analysis predicted. But here's the brutal reality that the market never explicitly advertises. If trading felt comfortable, everyone would be profitable. If holding winning positions for days or weeks felt natural and easy, every retail trader with a smartphone would be financially independent. The entire retail trading industry would be populated by millionaires who simply followed their gut feelings and let trades run to massive targets. Obviously, that's not reality. The reality is that roughly 90% of retail traders lose money consistently over time. And the primary reason isn't bad analysis, poor market timing, or lack of technical knowledge. It's that they exit positions the moment psychological discomfort exceeds their personal tolerance threshold. They sell relief instead of selling edge. The discomfort you experience when holding a 4-hour position, not knowing every single tick movement, not micromanaging every minor pullback, not having complete certainty about what happens in the next candle, that's not a malfunction in your psychology. That's exactly where your actual edge lives. That anxiety you feel is your amateur brain, the part still wired for immediate gratification and constant feedback, screaming at you to do something, anything. Just don't sit here in this uncertainty. But uncertainty is not optional in trading. Uncertainty is the entry fee for participation in profitable moves. You cannot extract the reward without accepting the psychological cost. The market doesn't offer you a comfortable path to wealth. It offers you a psychologically brutal path that most people will abandon before reaching the destination. Your brain treats market uncertainty the same way it treats physical danger. From an evolutionary perspective, if you heard rustling in the bushes, you didn't wait for confirmation, you ran immediately. That same threat detection system fires when you see your unrealized profit shrinking or your position moving against you temporarily. Your amygdala doesn't distinguish between a 2% drawdown and a predator stalking you. Both trigger the same fight or flight response that demands immediate action to eliminate the threat. Jesse Livermore learned this lesson through the most expensive education possible, paying tuition with his own capital repeatedly before the lesson finally stuck. Early in his career, when he was still trading on emotion rather than systematic process, he would identify solid positions with excellent risk-reward profiles. He'd enter with conviction based on sound analysis. His market timing would be accurate. Everything would be properly structured for a significant winner. Then the psychological warfare would begin. He'd sit there, watching the tape, interpreting every fluctuation, reading meaning into every minor pullback. The discomfort would build steadily, hour by hour, until it became unbearable. He'd exit the position early, rationalizing the decision as prudent risk management or smart capital preservation. Then he'd watch in complete frustration as the move continued exactly where his original analysis had predicted. The stock would eventually hit his target without him aboard. He'd experience the dual pain of missing the profit, combined with the humiliation of knowing he was right about direction, but wrong about execution. The worst part of this cycle was what happened next. Driven by the fear of missing out and the need to recapture what he'd lost, he'd often re-enter the same trade at a much worse price. Now he was positioned with less favorable risk-reward just as the inevitable pullback arrived. When that correction hit, he'd panic again and exit, taking a loss on a trade that should have been profitable from the beginning. He called this destructive pattern the impatience tax. Every single time he couldn't sit still and endure the discomfort of uncertainty, the market extracted a fee directly from his account. He realized he wasn't losing money to market unpredictability or poor analysis. He was paying a penalty for his own emotional inability to sit still when sitting still was exactly what the situation required. The professional trader eventually learns to completely flip his interpretation of discomfort. He trains himself to read anxiety as confirmation rather than warning. When you feel that urge to check your position for the 15th time today, when you're lying awake at night thinking about your open trades, when you desperately want to move your stop loss closer to current price, those sensations mean something very specific. They mean you're positioned exactly where amateurs are folding their hands and walking away from the table. And if amateurs are exiting due to psychological pressure, who's collecting their abandoned positions at discounted prices? You are, provided you can tolerate the heat long enough for the market to prove your thesis correct. Here's the identity shift that changes everything, and it must become absolute in your thinking. Waiting is not passive. Waiting is not the absence of trading activity. Waiting is your actual position in the market. When you're in a trade with properly defined risk, appropriate position size, and alerts set at your stop and target levels, you're not doing nothing. You're actively holding an edge that most traders surrender within hours of entry. You're performing the heavy psychological lifting that separates consistent profitability from perpetual struggle. The market doesn't pay you for physical activity like clicking buttons or drawing lines on charts. The market pays you specifically for psychological endurance, for your ability to tolerate uncertainty longer than the crowd can manage. But understanding this concept intellectually and executing it when real money is at risk are completely different challenges. You cannot expect to hold a position through 3 days of volatile price swings if you've never trained your nervous system to tolerate 3 hours of uncertainty. Psychological endurance isn't built during the trade, when emotions are running high and money is on the line. It's built systematically before the trade through deliberate preparation and environmental design. There are 3 foundational principles for building this capacity, and if you ignore any of them, no amount of willpower or positive thinking will save you from sabotaging your own trades. Position size determines your psychological capacity. This is the root cause of roughly 90% of all trading anxiety. If you're risking 5% of your account on a single 4-hour trade, you will check charts every 10 minutes. You won't be able to help yourself. The potential financial loss is too significant for your nervous system to ignore. Your brain will interpret that level of risk as existential threat, keeping you in a constant state of fight or flight activation that makes rational decision-making impossible. Your amygdala knows that a string of 3 such losses would devastate your financial life, so it maintains hypervigilance, scanning constantly for danger signals. Every red candle becomes a crisis. Every pullback feels like impending disaster. You cannot be a lazy trader while carrying aggressive position sizes because your biology won't allow it. But if you reduce your risk to 1%, or even 0.5% of your account, the psychological dynamic shifts immediately. You can breathe. You can walk away from the screen. If the trade hits your stop loss, it registers as an annoying business expense rather than a personal catastrophe. Livermore's rule was elegantly simple. Size your position so you can sleep peacefully at night. If you're waking up at 3 a.m. to check quotes on your phone, you're trading too large relative to your psychological capacity. The mathematics here are non-negotiable. You cannot build the endurance required for 4-hour timeframes while operating with position sizes that trigger your threat detection systems. It's like trying to learn meditation while someone holds a loaded gun to your head. The perceived danger level is too high for your mind to relax into the process. Replace the compulsion. Don't fight it. The urge to check your charts is a deeply ingrained habit loop that's been reinforced potentially thousands of times. Your brain has learned to associate market uncertainty with the need to gather more information. When anxiety about a position arises, your automatic response is to open your trading platform and check the current price, seeking temporary relief through the illusion of control. Trying to suppress this urge through raw willpower alone is exhausting and usually fails. Your brain needs somewhere to direct that compulsive energy. Instead of fighting the impulse, you need to redirect it into productive channels. When that familiar itch to check charts hits, immediately open your trading journal instead. Force yourself to review your last 5 winning trades, focusing on what made them work. Read your trading rules out loud. Write down exactly what you're feeling in that moment. I feel anxious because price is consolidating at resistance, and I'm worried the breakout was false. This writing process accomplishes something crucial. It moves the emotion from your amygdala, the fear center of your brain, into your prefrontal cortex, the logic center. You transform subjective anxiety into objective data that you can analyze rationally. You're redirecting the compulsive energy into an activity that reinforces your discipline rather than undermining it. Third principle. Time box your market involvement with surgical precision. Set exactly 2 specific times per day when you're allowed to check your 4-hour positions. For most traders, 9 a.m. and 6 p.m. creates an effective rhythm. 1 check in the morning to review overnight action and plan the day ahead. 1 check in the evening to review the session's developments and prepare for tomorrow. Outside those 2 predetermined windows, the market literally doesn't exist in your world. Not metaphorically, literally. You cannot check prices. You cannot glance at charts. You cannot scroll through trading Twitter or financial news websites. You're creating artificial market hours that align with your psychological needs rather than the market's 24-hour availability. This approach sounds extreme because it is extreme. But if you're currently checking your positions 40 times per day and bleeding money despite accurate analysis, you don't need minor adjustments. You need complete structural reform of how you interact with market information. Time boxing serves 2 critical functions. First, it dramatically reduces the number of decision points where emotions can interfere with your plan. Second, it trains your nervous system that anxiety can be tolerated without immediate action. You feel the urge to check, but you don't act on it. The discomfort rises and falls naturally. Nothing exploded because you didn't stare at a price chart. That experience gradually rewires your automatic responses. When you implement these 3 principles together, the first few trades feel almost unbearable. You'll want to check constantly. You'll convince yourself that this particular trade is different and requires special monitoring. You'll create elaborate justifications for why the rules don't apply to your current situation. But if you maintain the discipline to follow your protocol, something profound shifts around the 3rd or 4th trade. You start noticing that the positions you didn't monitor obsessively actually performed better than the ones you watched constantly. You realize that your interference was the problem, not the solution. You begin trusting your systematic process more than your emotional impulses. Eventually, you reach a psychological turning point where the discomfort itself becomes your confirmation signal. When you feel that familiar urge to check, that anxiety about your position, you recognize it as proof that you're doing something most traders cannot do. You're staying in the trade while the crowd exits. You're enduring uncertainty while amateurs seek the comfort of premature closure. The crowd exits when holding becomes uncomfortable. They sell at the bottom of pullbacks because the psychological pain exceeds their tolerance. They buy at the top of extensions because the fear of missing out becomes unbearable. They are slaves to their need for emotional comfort, which makes them predictable sources of liquidity for professionals. You stay. You endure the pullback because your structural analysis remains intact. You ignore the extension because your target hasn't been reached. You sit calmly in the fire of uncertainty and refuse to flinch. That ability to remain positioned while others flee is your edge. That's why the market pays you. We've established the psychological framework and the identity shift required for professional execution. Now we need to convert this understanding into a mechanical system that removes temptation entirely. In the next chapter, we'll build a bulletproof execution protocol that forces you to trade like a professional, even when your emotions are screaming at you, to interfere with perfectly good setups. You don't rise to the level of your intentions. You fall to the level of your systems. This is not just a clever line, it's the backbone of professional trading. Every trader enters a new week vowing to be more disciplined, to let winners run, to stop micromanaging every tick. But when the trade is live, and your capital is fluctuating with every candle, good intentions vanish under the pressure of real risk. What remains is whatever structure you've built in advance. Your process, your protocol, your environment. If that structure is absent or weak, you'll default to amateur habits every single time, no matter how much theory you understand. That's why we convert all psychological insight into mechanical process. We stop relying on willpower and start building a cage for our inner amateur, a system that forces us to act like professionals, even when our instincts are screaming for action. Here's the exact step-by-step protocol for turning timeless trading psychology into profitable, low-stress 4-hour trades. The lazy trade is not careless. It's a position built on patience, rigor, and environmental design. Phase 1 is the setup, and it begins before you even open your 4-hour chart. Every morning, your first task is to anchor yourself in the higher time frames, daily, sometimes weekly. The goal is not to chase entries, but to read the market's landscape. Where is the dominant trend? Where did price last change character in a meaningful way? Focus on marking only the major support, resistance, and pivotal points, those areas where institutional money has previously stepped in or out decisively. Ignore minor swings. You want the levels that shape the market's real structure. With your landscape mapped, ask yourself one simple, binary question. Am I a buyer, a seller, or flat today? This isn't a forecast. It's a declaration of your directional bias based on objective structure. If you see a clear uptrend, higher highs and higher lows above key support, you're a buyer. If the daily is rolling over or stuck in a range, maybe you're flat. If the structure is breaking down, you're a seller. Whatever your bias, write it down in your trading journal with a timestamp. If it's not written, it's optional, and professionals systematically remove optionality. Writing your bias is not just discipline, it's accountability. When you review your journal, patterns emerge. Do you abandon your bias after minor pullbacks, or do you change direction based on structure, not emotions? This is the firewall between logic and impulsivity. Phase 2 is the hunt, your 4-hour battle plan. At each 4H candle close, return to your chart and update your key levels with fresh data. Now, with your daily bias fixed, you hunt for setups that align. Here's the professional's edge. You look for 0, 1, or at most 2 possible lazy trades. 0 is a valid answer. Most days, there's nothing to do, and waiting is a position. This keeps you out of marginal setups born from boredom or FOMO. For any setup you consider, pre-commit to every parameter before you touch the order ticket. Define the exact entry price, the exact stop loss placed at the structural point where your idea is invalidated, the exact take-profit target, and the exact position size. This is not discretionary. Use the non-negotiable formula. Position size, tech. Entry price, stop loss. Risk amount. So if you have a $500 risk budget, an entry at $52, and a stop at $50, your risk per share is $2. $500 divided by $2 equals 250 shares. Not 300 shares because you feel good about this one, not 100 because you're scared. The math is your boss. This removes emotional improvisation from your process and ensures each trade normalizes risk regardless of distance to stop. Phase 3 is the wait, the environmental control that turns discipline from a heroic act into the path of least resistance. Once your order is in and your stop and target are live, your only job is to make it hard to interfere. First, close your trading platform completely, not minimized, not hidden, but closed. If you want to check your position, you must deliberately reopen it, adding friction that gives your rational mind a chance to intervene. Second, remove trading apps from your phone during active trades. If that sounds extreme, ask yourself how many times your phone has been the gateway to impulsive exits or random stop fiddling. Reinstall the app when flat, not during trades. Set alerts only at your stop loss and target. No intermediate alerts, no notifications at arbitrary milestones. Your phone should buzz only if the trade is finished, one way or the other. Everything else is noise designed to tempt you off your plan. Finally, schedule 2 daily check-ins, 9 a.m. and 6 p.m. These are the only times you're permitted to review open trades. During these windows, you can update your journal, plan adjustments, or reset alerts if structure demands. Outside these windows, the market does not exist. This is not toughness, it's architecture. You're designing an environment where the easiest path is the right one. Phase 4 is the execution, the mechanical response that removes emotion and second guessing. When your stop alert triggers, close the trade immediately. No negotiation. No just giving it a little more room. No revenge trading. Your stop is a line in the sand. Idea invalidated. Move on. When your target alert triggers, close and celebrate. Don't wonder if you could have made more. Your system is not about catching every cent, but about repeating a positive expectancy process over hundreds of trades. And if neither alert triggers, do nothing. Waiting remains your position by design. Do not tweak out of boredom. Do not move stops to break even just for comfort. Let the market do its work. Your job is already done. Let's see this protocol in action. Suppose a trader spots a 4-hour uptrend breakout on April, confirmed by the daily chart's clear higher highs and support, at $147. Price consolidates just under minor resistance at $150. He writes, bias, buyer above 147. On the 4H, he plans to enter at $150 on a confirmed close above. Stop at $147, target at $156 the next resistance. He risks $600, so $600, $3, $147, callous 200 shares. He logs, Apple long 150, stop 147, target 156, size 200 shares, risk $600. He sets a buy stop, attaches his stop loss and take profit orders, sets 2 alerts, 147 and 156, closes his platform, and removes his broker app from his phone. For the next 36 hours, he doesn't watch a single candle. He doesn't see the dip to 148.70 that would have terrified him. He doesn't feel the urge to protect gains by selling at 151. When his phone buzzes at $156, he calmly closes the trade, books his $1,200 profit, logs the result, and moves on. Contrast this with the amateur, glued to the screen, checking the trade 47 times, moving his stop twice, and getting stopped out at 149, missing the move entirely. Same setup, same analysis, radically different outcomes. The professional structure protected him from his own emotions. Before every session, run a 3-question mental checklist. Is my maximum dollar risk fixed and truly acceptable? If stopped out, can I shrug and move on? Is my stop placed where the idea is structurally invalid, not just where it feels safe? Am I genuinely prepared to let the trade hit, either stop or target without interference? If you can't say yes, reduce your size or pass. The system is only as strong as your commitment to let it work. Remember the maxim, the market pays those who can afford to wait. It taxes those who must act. This protocol is not about guaranteeing wins. It's about guaranteeing that you act like a professional, process-driven trader, regardless of outcome. You've now built the architecture for high-retention, low-stress 4-hour trades, but the final test is coming, when the trade moves against you, when your unrealized loss grows, and every instinct screams to interfere. That's where the true psychological war is fought, and in the next chapter, we'll build your resolve to win it. The real test of the lazy trade isn't when you're winning. Anyone can hold a position that's moving in their favor. Your dopamine is firing, your account balance is climbing. The psychological feedback loop is positive. Holding winners feels natural, because your brain is getting exactly what it wants. Confirmation that you were right. Reward for your effort. Proof of your competence. The true examination of your character as a trader reveals itself in a completely different scenario. You're positioned in that Apple breakout at $150. Your stop is clearly marked at $147, placed deliberately at the structural level where your thesis becomes invalid. But price hasn't cooperated with your timeline. Instead of launching immediately toward your $156 target, it's pulled back to $148.50 and is just sitting there, bleeding slowly, tick by tick. Your unrealized loss is $300 and climbing with every red candle that prints. This is where the amateur's brain catches fire completely. He's no longer thinking about market structure, trend continuation, or statistical probabilities. His entire mental bandwidth is consumed by loss aversion and catastrophic thinking. He's calculating how much worse this could get if it keeps dropping. He's imagining the humiliation of getting stopped out for the full loss. He's replaying his entry decision, searching desperately for the mistake he must have made. His hands are hovering over the close button, and his internal dialogue has shifted from analysis to pure survival mode. The story he tells himself sounds perfectly reasonable. This looks weak. The momentum is gone. If I exit now, I can save $150. I can preserve capital and live to fight another day. I'm being smart about risk management. So he clicks sell at $148.50, locking in a $300 loss. He feels immediate relief as the position disappears from his screen and the psychological pressure evaporates instantly. Then, the next day, Apple reverses sharply and drives straight to $156, exactly where his original analysis predicted. His perfectly valid thesis played out precisely as planned. But he collected $0 because he couldn't endure 24 hours of temporary discomfort. The professional trader in the identical position does something that looks absolutely insane to the amateur. He does nothing. Literally nothing. He doesn't move his stop closer to current price. He doesn't exit to preserve capital. He doesn't check lower time frames to gather more information. He doesn't post in trading forums asking if he should be worried. He sits in the fire of uncertainty and refuses to flinch. Why? Is he reckless? Does he enjoy losing money? No. He does nothing, because his stop at $147 is not just a random number. It's the boundary of his thesis. It's the structural level where his idea about market direction is proven wrong. Until that line is crossed, the trade remains valid according to his systematic approach. The current price of $148.50 is simply noise. Uncomfortable noise that tests his discipline, but noise nonetheless. Here's the brutal truth that most traders never internalize despite hearing it repeatedly. You don't get stopped out by the market. You get stopped out by yourself. The market didn't invalidate the Apple trade at $148.50. The amateur invalidated it himself by exiting before his predetermined stop was hit. He surrendered his statistical edge voluntarily because watching a losing position created more psychological pain than he was trained to tolerate. Most retail traders exit before their stop is ever touched. They set stops as a formality, a box to check in their risk management protocol, but they never actually let those stops do their job. The moment unrealized losses exceed their personal comfort threshold, they override their own system and exit manually. They genuinely believe they're being prudent and responsible. In reality, they're systematically abandoning their edge every single time market noise creates temporary discomfort. Jesse Livermore made this exact mistake repeatedly in his early trading years, and it cost him fortunes. He would identify a solid position with clear structural support. He'd enter with conviction based on sound analysis. He'd set a logical stop at the invalidation point. Then price would pull back within the normal range of fluctuation, and his emotional brain would completely override his logical plan. He'd move his stop closer to current price, telling himself he was just being safe or tightening up his risk management. The market would hit his newly tightened stop, taking him out of the position at the worst possible moment. Then, with Livermore now flat and nursing a loss, price would reverse and march straight to his original target without him aboard. This pattern repeated so many times that he eventually gave it a name: the amateur's trap. He realized the stop is not a suggestion or a flexible guideline. It's the absolute boundary of your thesis. Moving it closer when you get uncomfortable is not risk management, it's self-sabotage dressed up as prudence. The market doesn't care about your comfort level. It only cares about structural levels where supply and demand dynamics actually shift meaningfully. The protocol for handling drawdown is simple in concept but agonizing in execution. If your stop hasn't been hit, you do nothing. Not almost nothing. Not just a quick check to see how it's developing. Literally nothing. You don't move your stop tighter. You don't exit early to lock in a smaller loss. You don't zoom into lower time frames to see how bad the selling pressure really is. You don't calculate how much more you could lose if it keeps dropping. You wait. Your stop is either hit or it isn't. There's no middle ground, no negotiation, no discretionary override based on how you feel. Let me give you a concrete scenario that illustrates why this protocol is absolutely non-negotiable. A trader identifies a clean 4-hour breakout above a multi-week consolidation range. All his criteria align perfectly: daily trend confirmation, volume expansion on the breakout, clear support structure below. He enters long with his stop 8% below entry, placed just under the breakout level where the entire thesis would be structurally invalidated. Within 12 hours, price pulls back 6% from his entry point. His unrealized loss is substantial. Every amateur instinct is screaming at him to exit immediately. He's tempted to close the position and live to fight another day. His hands are literally shaking. His stomach is tight with anxiety. He's experiencing genuine physical discomfort from the uncertainty, but he does nothing. He honors his systematic approach. His stop is still 2% away from being hit. According to his rules, the trade remains completely valid. He closes his trading platform. He removes the app from his phone. He goes to the gym. He sleeps. He trusts the process he built when his emotions weren't compromised by live risk. The next day, price reverses sharply. The breakout thesis proves correct. Price drives through his target level, and he captures the full move, a winner that pays for his previous 3 losses combined. He profits specifically because he was willing to endure temporary discomfort that the amateur could not tolerate for even a single day. The amateur in the identical trade would have exited during that 6% pullback. Same technical analysis, same entry price, same setup structure, completely different outcome. The only variable was psychological endurance. The amateur's exit wasn't based on market structure or invalidation of thesis. It was based purely on his inability to watch red numbers on a screen without taking action to eliminate the discomfort. The professional's mindset is absolute and non-negotiable. The stop is the trade. If you're not willing to let your stop get hit in full, you shouldn't have entered the position in the first place. Your stop distance should reflect the volatility of the instrument and the structure of your thesis, not your personal comfort level with seeing unrealized losses. Exiting before your stop is hit is actually worse than getting stopped out. At least a stop out is part of your plan. It's an expected outcome that you've already accepted as the cost of being wrong. You sized your position appropriately for that loss. You've accounted for it in your risk management calculations. Getting stopped out is professional business execution. But exiting early, before your stop is touched, is pure sabotage. It's you interfering with your own system, because you lack the psychological capacity to execute your plan under pressure. It's the market teaching you an expensive lesson about the difference between having a system and trusting a system when it matters most. Let's close the loop we opened at the very beginning. Remember that $2,000 trade that got away, the one you identified perfectly, entered correctly, but couldn't hold through to the target. The only difference between capturing that profit and missing it entirely was the ability to sit still when it became uncomfortable. Same technical analysis, same entry price, same risk-reward setup. The only variable was psychology. Here's your 4-rule recap for owning the lazy trade, for transforming yourself from amateur to professional executor. Rule 1. Size small enough that fear doesn't override discipline. If you're checking charts every 10 minutes, you're trading too large. Reduce size until you can breathe, until a stop-out registers as annoying rather than devastating. Rule 2. Pre-commit to your time frame and never check lower. If you're trading the 4-hour chart, you have no business looking at the 15-minute or 1-minute. Lower time frames show you noise that your system isn't designed to interpret. Rule 3. Set alerts at your stop and target, then walk away. Close your platform. Remove apps from your phone. Create physical distance between yourself and the temptation to interfere. Rule 4. Honor your stop. If it's not hit, you do nothing. This is the iron law. Your stop is the boundary of your thesis. Until it's crossed, the trade remains valid. These 4 rules sound simple, because they are. But simple doesn't mean easy. The amateur thinks edge comes from sophisticated indicators and complex strategies. The professional knows that edge comes from simplicity, executed with unwavering discipline. The lazy trade isn't lazy. It's lethal. It's the willingness to do nothing while the market does everything. It's the capacity to sit still while the crowd panics. That's where the money lives, not in the frantic activity, but in the patient wait. If this lesson has landed, the next one will multiply your results exponentially. Why adding to winning positions too early kills more accounts than bad entries ever will. Until then, cut losses fast. Size small, own the weight,